So I'm Mike Shea with Total Mortgage. A lot of you here know me, some of you don't. Nice to meet you if I haven't met you before. I got some flyers here for you. We're not going to go through the stuff on the flyers. If you have any questions about those items, please let me know. Tried to give you some stuff that's going to be, pertaining to help you with the process of 203Ks and home styles. So some of you may or may not know that there are FHA 203Ks for reno, and then there's also a home style for reno, which is a conventional product. So you might have clients that don't want to go into the FHA product, which is fine. And in fact, the conventional product will allow you to do things that the FHA will not, like structural work. And we'll get into that later. One of the pieces I wanted to bring your attention to is this green light approval piece. So I've been in the business for 10 years and moved over to Total Mortgage back in September. This is the best thing right now going because it helps me get your offer accepted. So what it's all about is getting your client's loan dialed in, and I mean credit letter explanation signed, letter of explanation signed, deposits, everything that the underwriter needs, done, down to the letter. So we have a clean commitment before you go out shopping with your client. So you know if they're good for conventional, you know that we've looked at their income, we know we looked at their overtime, their W-2s, their pay stubs, we did the VOE. It's all underwritten already. So then we can close, guaranteed to close in 21 days. So that's going to get your chattel loans approved, and it can bring you to the top of the heap because we can eliminate the mortgage contingency, put in an appraisal rider, but you can get rid of the mortgage contingency clause. And I've had more green lights get their offers accepted recently than not. So that's a big process, big part of the process.
How long is that good for?
Well, the credit report's good for 120 days. So as long as nothing changes in their profile, they're still good to move forward. I can always do another soft pull to check their score, which isn't going to affect their credit score. So, the credit report's good for 120 days, and that's really the telltale sign, because if someone scores a 720 and all of a sudden they didn't make a couple of mortgage payments or something and it drops to a 580, we're going to want to know about that before they go under contract.
So once they have the green light, it's 4 months.
Right, exactly. And then we can reapprove them. Just pull their credit again, get another pay stub, make sure they're still working.
How long does that process take?
Depends on the borrower.
How long does the process take?
Right, the Elvis on top.
So it depends on the borrower. I had two sisters, and it took them a month and a half to get me all their stuff.
Right, but once you have everything, how long does it take to get through that process to get the green light?
Again, kind of depends on how busy my processor is. It could take as little as 2 days. It could take as much as a week.
I did have buyers submit offers on one of my listings, and one of them had the green light, and the sellers loved it. And we closed in 3 weeks, so it was fantastic.
Yeah, we're ready to hit the ground running. It's like, even if it's been a few weeks, we update pay stubs and bank statements, and then we can order appraisal title right away and just, move right into underwriting. So it's been great. So I wanted to bring your attention to that. I'm not going to go on any further. This is Charlie from our reno department. He's going to kind of go through the ins and outs of renovation loans, and then we can do a Q&A at the end where I can, answer some questions about nuts and bolts and numbers and whatever else you guys want to get into.
Absolutely, or scenarios, actual properties, whatever you want to talk about. Yeah. So first off, I'll start by saying, well, that's me, Charlie Napolitano. I'm in the business a long time, longer than I want to admit, 25 years. Half of that time I've specialized in renovation lending, which to the convinced, that's the 203K, right? Which is what everybody knows. But it's more than that. It's way more than that. We're going to talk about that. We're talking about a challenging market. Can you stand it anymore? Can we talk about that anymore? But that's what we're in it. It's been years now, But I'll tell you what, we're going to talk about why this is a solution, really, to a big problem. You know what the problem is? Inventory. Wild guesses, right? If you don't know about Total, I just want to throw this in there. I don't know how long you guys know Mike and everything. This company is #1 4 years running in Connecticut. The #1 purchase lender in Connecticut. There's a reason for that. And that's above everybody, every bank, every lender, all of them. I have been at Total Mortgage for, ready for this, since January. Right? Again, I'm in the business 25 years. They recruited me in January to start their renovation lending platform. I was running Norcom's platform for 6 years, and before that, Prospect, and I've been doing it a long time. But they decided to bring this product in-house. And what that means to us and to you guys is that we control it, we do it, we handle every aspect of it, like all of our mortgages. Most of our competitors can't say that, which is why these loans have the bad reputation that they've always had, because usually people lose control. They lose control of the deal and they don't know what to do. And my department, it's all we do. So when a guy like Mike has a transaction that's going to use a renovation mortgage, his team handles the renovation mortgage. I mean, the mortgage, like every other aspect, they always do. But now they have a team behind them that's taking care of the annoying part, the bid and the contractor docs. And we make it like they don't even see it. We just get it taken care of. We work directly with the people who handle that piece because we speak their language and it's what we do. So anyway, that's total. Just a little background there, right? Renovation mortgage. I already said it, right? You guys know what I'm talking about. These days, a few years ago, nobody had a clue, unless I said rehab loan, and then people be like, oh yeah, rehab, right? I know those. Or 203K. People are like, yeah, okay, I'm with you. Some people have had great experiences. Some people have had bad experiences. Have you guys had any experiences with these? Good and bad, I would assume, right? Good and bad. It's a great opportunity, a great solution, but it can be cumbersome if people aren't experts at it. Homestyle. That's Fannie Mae's version of this. That's Fannie Mae's 203K. Choice Reno is Freddie Mac's version. In case our borrower is better served by a Freddie Mac loan instead of a Fannie Mae loan, right? It might be, well, they don't need the reserves with the Freddie loan, or Fannie Mae is not saying yes, but Freddie Mac is because it doesn't care about the higher income ratio, right? Something like that. So having these options, needless to say. Solutions, opportunity, solve a problem. What's the problem? There's our problem, okay? And the renovation mortgage business has always been about the same thing, really. It's always been about old houses. That's what renovation mortgages really are, why they were invented. By the way, how many of the houses out there in our world are old right now? Most of them, right? Houses were built a long time ago in general. There's not a lot of new stuff. The solution to this is a renovation mortgage because we can expand a buyer search. We can expand a search to look at houses maybe we know need something. Maybe we know this house is on the market too long for a reason, right? Like, Jesus, how long is this? You've heard me say this. How long is this house on the market? 2 hours. What the hell's going on? Why is it still, it must need a new septic. It's still on the market, something's wrong. But seriously, folks, no. With these, we can increase the number of houses that we can show. There's less competition on the needier stuff, right? Are there going to be 20 cars in front of that house that needs a roof right now on a Saturday? Maybe not. Maybe not. Maybe there's only a few cars in front of that house at the open house. More buying power. Buyers get what they want, no matter what type of renovation mortgage they're doing. You could do, by the way, a buyer can buy a house that's turnkey, perfect. Nothing wrong with it, perfect. It doesn't have a big deck on the back. Boy, I wish it did. It would be the right house. Great. Buyer gets what he wants. You can do a renovation mortgage and include just that new deck or just brand new appliances and nothing else. It doesn't have to be broken. Nothing has to be broken. But it could be. And the seller doesn't have to make any repairs. This is why when some people say it's hard to get one of these offers accepted, sometimes it's really easy to get one of these offers accepted because the seller doesn't have to make any repairs. And we know there might be an issue, and I'm so scared of what the appraiser is going to say, right? Like, whatever could come up. But beyond that, our buyer is already shopping this way. They know that they're looking at a house that may need something. They're prepared. We've educated them. They're not afraid of what they could come across. So whether it's repairs or improvements, the seller can think, I don't have to do anything, It's a nice selling point.
Good for bank-owned homes, too.
No, it's great for bank-owned homes, of course. If there's anything wrong with the house, it's not going to finance. You can buy it with a conventional mortgage, a government mortgage, as long as it's a renovation. We're going to include whatever's wrong with that house. At the time of purchase, they're going to close as is, right? The work's going to happen after closing. So even if when the appraiser goes out there, when Mike sends out the appraiser and there's 6 inches of water in the basement, It doesn't matter because the appraiser has a contractor bid for plumbing that's going to take care of our pipes issue, whatever, whatever it could be. More negotiable. There's more negotiating power, of course, if we're looking at houses that maybe aren't perfect, right? And we can win listings with this kind of solution for these houses that need something, right? So here's a quote for you. Any house can be modernized with a renovation mortgage. You can update kitchens and baths, floors, roofs, basements. Do you know you could add a garage or a deck or a patio? Even fences, driveways, or appliances. Do you know who made that? Who said that quote? Any idea? Me. A couple of months ago. I say it all the time. I want to remind you guys, in case I forget to mention driveways and fences. Stupid things, like keep in mind, like I said, my message, you're starting to see the message, right? This is like about, yes, it's about the broken houses. Great. We're going to do a ton more foreclosures. Like, I went through that, right? I don't want to deal with that again, but we're going to do a lot of renovation mortgages on them. So I said houses are old, right? How old are they? They're 80s old, people, okay? Take a look at what happened in the last 40 years. Look at what happened to Vince Neil. Do you guys know who Vince Neil is? Do you know who he used to be? That's who he used to be. All right. 40 years is a long time, people. Do you know that the average in the country, houses were built in the 80s and before the 80s? Look at poor Madonna with the bad renovation. And look at the Bangles, the poor Bangles. And Axel has never been angrier. So, but look, you get the point. It's old stuff, right? Well, let me tell you, I do one sometimes internal. Have you seen the internal one where I'm like just talking to the salespeople? I put up a picture of myself in 1986, and I look just like that. It superimposes right over Tommy Lee, and I'm like, I mean, you guys probably get the idea. You look at me like you probably get the idea. Like, okay, wait, something's going on there. Anyway, let me tell you guys what you really need to know. Like I do these things like this, right? I'll talk for another 15 minutes. You ask questions. We can go deep and we can talk about details. Like, no problem. You guys could be with a client together, pick up the phone. Mike, if you called me on a Saturday or a Sunday and get me, if you haven't, you will. Seriously, I get calls from loan officers on the weekend because they're with their agent or the buyer. Can we do this? Can we do that? Yes, yes. We can't afford to lose an hour, right, in this market. What you need to know, this is what I was going to say. I teach a continuing education class in Connecticut also. I've been doing it for like 12 years. All the different boards of realtors. If you've never been lucky enough, it's 3 hours of this. It's fun. But it's a 3-credit class. We do it privately. We're hooked up with a school, so you'll hear about it. We'll offer that class. But in all that 3 hours, like what you're going to hear right now is really what you need to know, okay, in the next 5 minutes. They're normal mortgages. There you go. There's nothing really crazy about these mortgages, except they're going to include in our transaction, not just the purchase, but also the improvement or the upgrade or the repair. It's going to be in their total acquisition price. When we build their mortgage, the purchase price is the purchase price is the purchase price. It doesn't affect the seller, right? We got to let them know what we're doing. We let them know that we're experts. We let them know it's not going to take longer, all that. But it's just a normal mortgage with a normal interest rate. Typically, 1/4 point, 3/8 of a point higher in the market than a regular non-renovation mortgage. That's the typical difference. And in all the years that I'm doing it, I don't know if I've lost a renovation mortgage for interest rate. I don't compete with anyone because there are people who do it. Don't get me wrong, there's people out there that do it, but there's not a lot of people who do it. Experts in it, a reputation doing it. It's not about interest rate, right? And by the way, when I start talking interest rate, CHFA, right? You guys are familiar with CHFA. How could you not be, right? Do you know there was one lender that was doing the CHFA 203K in Connecticut? Only one. You know who it was? Does anybody ever do one? It was Norcom. I was doing them. I was the only one doing them before I got recruited over here. Guess who's now the only lender that does the 203K CHFA loan now? Wild guess. Total Mortgage. It's being released in about 2 weeks, just so you know. So you can start talking about it. Just you didn't hear it here. Mike said it. my boss runs the mortgage part of the company, so I didn't say it. But why I brought that up, the 203K CHFA loan is the same interest rate as the regular CHFA loan. There's no reason not to do it. Wow. Period. No reason. And I'm going to show you a slide, but with a 203K, it's the only time ever in a mortgage where there's a value cushion. If a house appraises low, the 203K actually adds 10% to the appraised value. I'm going to show it to you. I'll tease you with that. Of course, it's about providing options. It's about solutions, right? One loan, one approval, one closing with one lender. That's the important thing, especially with Total. Like, you know, like my partner at Total, they're going to handle this all the way through, not just the loan, but the closing and then the renovation, beyond the closing. Let me bust a few myths for you. I think I already did a lot of this, right? It's not just rehab and foreclosure anymore. It's not just repairs. All my years doing it, most realtors, the biggest number one thing is, I thought it was repairs. I didn't know you could do just a basement. I didn't know you could do just redo the bathroom, you know, whatever. It's not just 203K. We've got the conventional versions now. I've been writing mortgages for many years. I know some borrowers are not going to do an FHA loan, right? Ever. Now they don't have to. They could do a home-ready Homestyle first-time buyer loan, 3% down with renovation. They could put down 5%, 10%, 20%, because my dad says you don't buy a house without 20%, period. Like, that's what I'm doing. All right, dude, do 20%. But now you can finance 80% of the house and 80% of the new garage, you know? I had a guy in last fall, bought a perfect little house. And I swear to God, I'm not making this up. It was CHFA, 203K, DAP, time to own. Yeah, I had hair. When I started the application, I had a full head of hair. No. But seriously, and this kid, and you want to know what he did? A garage. He built a garage. That's all he did. There was nothing wrong with the house. It was really cool. Anyway, not just first-time home buyers, guys, because even when it is FHA, like that's not first-time home buyer. You just can't have two FHA loans going at the same time. You can do a FHA loan over and over again. They do not take months to close. We close these on contract date. Last month, I called them out on one of our sales calls. I had 3 loans that closed in 29 or less days that were renovation mortgages. That was really like a feather in the cap. That was cool. They do not require any kind of certification for a contract, like some special contractor. They have to be licensed and insured in Connecticut. They're on their website. Whoever they know, as long as they're licensed and insured and they're legit, and we check their references, they choose who they want. The buyer chooses the contractor. We make sure they're acceptable. That's all. And can we help? Yeah. Do we refer contractors? You know what? You need to use Joe Smith contractor. You know, like, no, we're not going to do that. But are we able to say, I know 10 guys that have done 10 loans with us in the last 10 weeks. You know what I mean? Like, call one of them. We can help. Because usually you guys, the biggest problem with this is finding a contractor. I know them all. You know, but I have them in my phone. Yes.
So I did do a renovation loan and we chose the contractor, but they had a whole bunch of paperwork to fill out to be approved. Do you have that too, where they have that whole package?
Yep.
So they still have to do all that package paperwork?
It takes them about 5 minutes. Seriously, because I fill them out every day. It takes about 5 minutes to fill out. And here's the thing. The answer is yeah, they do. It's a homeowner contractor agreement. It's like your bid says you're doing $24,000 worth of whatever. Well, here's this contract. It agrees with that. And contractor agrees how he's going to get his money. It's a few, you know, a W-9 because we're going to write a check to the contractor. So they do fill it out. However, we've made it easy. We have it in one PDF. It's electronically fillable. We email it out of our loan system right to the contractor. He fills it out electronically, emails it back. My team picks it up and cleans it up and corrects it, fixes it. We leave him out of it. We leave you guys out of it. We leave our buyer out of it, you know? We make it easy. So, by the way, there is an investor renovation loan. Were you aware of that? It's only single families, so you know. It's through Fannie Mae and Freddie. Single family investor follows their guidelines. By the way, any of the renovation loans follow agency guidelines. When you're with a direct lender, like we don't have overlays stuck on top because Plaza Mortgage is gonna kill it and ask for all kinds of weird crap. You know, like we don't have that. So it follows agency guidelines. If FHA says yes with a 53.7 DTI, debt to income ratio, like, it's a yes. If the approvals, if the AUS says yes, we say yes. How do they work? The house plus the renovation, which is the total acquisition that we call it, right? Minus their down payment equals their renovation mortgage, equals their dream home, right? So it's for all buyers, all properties. It doesn't matter the condition of it, as we've been saying. From cosmetic, just appliances, to a tear down, we can actually do, and we do them. Tear a house to the foundation, build it back up, 3.5% down payment, you know? Yes. Donahue?
So when you write the purchase contract, obviously I know it's the same, but when you're talking to the client or the lender's talking to the client, we do have to educate them that they're taking out a loan for, like, let's say the purchase is $350, like their loan is off $400,000 if it's a $50K renovation.
Pre-approved for that $400,000.
Right. So when we're talking numbers, we have to kind of make sure that they understand that they'll be taking out a mortgage for $400 despite what the purchase contract says.
Oh, absolutely. Yeah, it's the idea that it's the total acquisition. So purchase plus renovation minus down payment. And that should be the only math you should ever have to think about in this scenario. Like, if you're talking about it for the first time and Mike hasn't gotten to him yet, kind of thing, you know, that's the only thing you really have to think about. Two things. You're going to be borrowing against the purchase and the renovation, right? But the value is also going to be based on the purchase and the renovation. That's the key. It's all about the after improved value. And I'm going to get a little more to that in a second. So all the work happens after closing, right? Buyer selected contractor, that's the after improved value. It's always based on the finished product. And it's about partnering with the right team to get it done, needless to say. So you have, we like this house, but clearly it needs a new roof, right? Get it with a new roof. Sell the house this way. Buy the house this way, right? And here's what it looks like. Here's a $290 purchase. This is obviously a year ago. $290 purchase. Where is this house? Can we get there? $15,000 roof. Again, my dad's a roofer. I'm only kidding. No, but that, I could get that roof done for 15 grand. Okay. There's their acquisition, right? This is how their loan is structured. It's a 203K, 3.5% down. That's their mortgage. Purchase is $290. That's their mortgage. Okay. By the way, that illustrates what that $15,000 roof does to their mortgage payment. It's $94 a month rolled into their mortgage payment. And out of pocket expense, guys, 3.5% of 15 grand is $525. So, you know, not only can we close as is, not only does this buyer have peace of mind, of course, whether the appraiser said it needed a roof or not. You know that, please, 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 appraiser, don't mention the roof. Please don't mention the roof. They don't have the money, you know, like, okay, it passed. Whew. But you know, it's gonna be raining in the house in a year or two. Like, and these people aren't gonna have the money. Like, you know what? Maybe you should think about doing a renovation mortgage, especially, like, think about it, especially if it's a Chaffa buyer. Hey, you know, you could roll in this roof. It's not gonna change your interest rate. Your payment's gonna go up a little bit, but now you don't have to worry and be awake at night. And oh, you, Mr. Realtor, when you sell this house in 3 years, you're selling it with a new roof. You know?
And it's a lot cheaper than these roofing companies that will finance you at 29% or whatever it is.
It's like getting a car.
Yeah.
You know? That you don't get to drive. Here's a kitchen. Same scenario. I mean, I'll go quick here. This is total acquisition. This is a Fannie Mae Home Ready Homestyle. So it's only 3% down, right? That 40 grand kitchen is $250 in their payment. But let's remember this, guys. We're pre-approving these people this way. We're pre-approving this buyer at 420 or 425. That's their comfort level, right? So now they're shopping backwards. They know they can afford a perfect house at 420 if that's what Mike pre-approved them at. But now they find this house for 375. They just figured out they have a budget for reno, right? If they found a house for 325, they've got another 50. So That's how, it's not a surprise, like, you know, like, hey, this is what it's going to be. It's, hey, a $400,000 mortgage is going to cost you X amount of dollars per month, depending on the taxes, right? Now, we've got our rental budget kind of worked in there.
So on that, excuse me. On that note, say Mike has a buyer of mine approved for $400,000, and because a lot of this might happen while we're out in the field, right? Like, oh, it needs a roof, oh, it needs a kitchen, anything like that. And say we were just doing regular, you know, I turn to you and I say we're going to do a renovation, and you would just update the pre-qualification. Do you have to run it through?
No,
there? Same. So it's okay, because that can happen quickly in terms of.
And if they were already in the system, the appraisal comes back. Uh-oh, we got a big problem, whatever the hell it is, right? It's the roof. What do we do? Well, we can flip it to a 203, or we can have the seller fix the roof, right? They're not going to mind. They're going to fix the roof. No. We're going to have the seller do it, and we're going to hit a button. We're going to turn it into a 203K. We don't have to reapply. We're going to only redisclose. The only thing that slows us down is that we got to get in gear and get a roofer and get his paperwork, right? But like, and I'm not saying this to, you know, like, wow, what a cool guy. I'm saying it the truth. I just did this with somebody in Massachusetts. I know the HUD consultants, the inspectors in different places. I know the different LOs, and I needed a roofer in a weird part of Massachusetts, and the deal was like gonna go sideways, and I made a couple calls. We found a guy. He's going there tomorrow because it's raining, you know. And but the point is, we can shift gears almost seamlessly and keep moving, even when we have something happen in the middle of it. In the pre-approval stage, it's a non-issue. They're pre-approved for a regular mortgage, they're pre-approved for a renovation mortgage. It's just about dollars.
Yeah, and in the middle of the loan, like you said, we can switch gears and switch the program. Just send out another loan estimate saying, here's your new program, here's your new rate, here's your new payment with this money worked into it.
We update the appraiser, you know, hey, Mr. Appraiser, you know, you called out this roof. Well, here's the roofer's bid. Now the appraisal is subject to, but it's subject to that bid, so it closes. You know, it's not subject to fix this. This is all the things you could do. It's not an all-inclusive list. It's everything and anything. That's the idea. It doesn't matter if it's, like in the old days, you can't do a luxury item. 203K is not gonna let you do that tennis court that you wanted or that sauna. You know what? Fannie Mae doesn't care. Fannie Mae lets you do whatever you want. I should say pickleball court now. I got to get with the times. You want to build a pickleball court, man? You know, it's anything and everything. Like we were saying, repairs, blah, 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 additions, put a second floor on a house, expand the house, expand the foundation. You can do an ADU. You can do an ADU that collects money. You can do living space over a garage. You can, you know, build a garage. Everything. Agent benefits, you know this. This is just a review, right? Expand the options. We're going to expand the inventory. That's the fact. House that needs anything, overcome, I like it, but man, this kitchen is a nightmare. I like it, but I don't have the money to fix this roof, you know? Would you consider the house if you could just roll that in, if you could include it in the mortgage? And you know if you're in the wrong house or not. I've been saying that for 25 years. No repair is needed, as is save deals subject to that appraisal. That, oh my God, we got chipping, peeling paint. We didn't know, we can't get it fit, you know, we'll just roll it in. Less competition, listings. Here's that example I wanted to give you guys about the value. All right, this is a 203K deal saver. This is literally, we have done a ton of these in the last couple of years especially. So now let me just do the disclaimer. It only works for 203K. It does not work on the conventional renovation loans. The conventional renovation loans are 100% of the after completed value, right? So you buy the house for $350 and there's a $50,000 kitchen, that's $400. We expect it's going to appraise for $400. Okay. Now, here's a 203K. Now we have a situation where we got a buyer who's buying a house for $420. House appraises 20 grand short. Seller's going to drop the price? Doubt it. Do they have another 20 in cash? Because we know that's the only way they can do it, right? They can't finance it above the appraisal. So, okay, here's the solution. I think you might have this flyer. Do they have that one? If they don't, they will. This is the appraisal gap flyer. Okay? We click that button and this loan becomes a 203K. Watch what happens. Now, we took this purchase at 420 and we decided they were going to throw in some brand new appliances. Okay? When they turned it into a 203K, just the nature of it, even though it's just appliances, even though it's not adding value, the appraiser sees it as 110% of the appraised value. It goes to 440. It's a guideline. It's the 203K guideline. It doesn't have to be appliances. I've done this where the people, it came in, I'm not even kidding, it was in Milford, it was a few years ago. House came in like 8 or 9 grand short. And like, oh my God, they wanted this house, wanted their family. And the LO said, if there was anything you could do to this house, what would it be? And before he even finished, they were like, that thing in the basement, blah, 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 blah. Like there was an asbestos wrapped pipes and stuff. And it passed appraisal and everything, but they didn't like it. They had 2 little kids. They didn't like it. So they built a $3,400 room around this thing, invented it and everything. Like literally, that's what it was. And the house, instead of appraising for 305, appraised for 335. And it, boom. Now, keep in mind, guys, this is the buyer. 420 plus 6, right? Minus their 3.5% down payment, okay? Their loan went up 6 grand. They financed these appliances. Hardly touched their loan. I'll show you that. It comes up, there we go. Out of pocket, 200 bucks for the appliances. And that, I didn't put it there. That 6 grand is probably 70 bucks in their payment, you know? Most importantly though, is that the seller got 420. The buyer paid 420, you know? And they were able to finance everything. So, keeps it going, keeps the transaction alive. Now you got some pictures. Your bathrooms, your total redos, your basements that don't have anything really wrong except that they could really use another 500 square feet, you know? Or that kitchen from the 70s. Or a disaster pool, you know? It doesn't have to be inside. It could be the backyard, it could be total refacing. It could be a house that has nothing wrong with it in Wallingford that needed this beautiful patio, you know? Fences, porches, garages, built-in pools, right? With a purchase, maybe not. Refinance, by the way, refinance. You have people that can't sell, they're not moving, they're not staying, they want to expand. We're doing a bunch of those right now. We're going to stay, we're going to expand. They don't need the same kind of equity that they used to. It's not an 80% cash out. It's a 95% refinance of the future value. That's from someone's house that I actually did. That's somebody's pool. He was a friend of mine, but he was a customer too. Like, built a pool, put it in the ground. Now his kids love him. Great flyers. All kinds of good stuff. Trifold brochures. Got to get you some of these. You could be standing with somebody and just flip through that brochure. It goes over all this stuff. Why us? We're the best. We're private, direct. We make all our own decisions. All that stuff you already know, right? And when it comes to this, our sales force utilizes my team. We do it all, you know, as far as the rental goes. So, questions?
So if, say I'm under contract with one product and, you know, we get to inspections or the appraisal calls out something, you flip them over to this 203K product. Do we have to get that approved? And maybe this is a question for Carl, by the seller.
Well, good question. Purchase contract always has to state that this mortgage is a renovation mortgage. So if it's a 203K, it's going to specifically say this is in the notes section or an addendum. You know, this is a 203K loan. Or if it's not a 203K, this is a renovation mortgage.
But I think what you're saying is like, okay, we're a regular conventional, right? And now we're switching to 203K. So in that case, we could do an addendum or something. You would have to get permission from the seller because you have to let them know that we're switching loan products. But you'd also do that with these guys too, to say like, hey, listen, here's the strategy going in. We're going to switch it. Our dates will stay the same. You know, we've got the solution to it.
Yeah. I think your biggest question there is switching from conventional to government. But switching from a conventional loan to a conventional renovation loan should have zero impact on a seller.
Him to call the listing agent and let him know.
The way I understand the contracts, we're applying for this mortgage. We're saying we're going to get this mortgage or better.
Correct.
So like they can say that they put 10% down, end up putting 20% down or whatever,
Right.
or better. So this,
Technically, any change you should tell the seller.
Yeah,
And you just
Not
don't
just
identify.
that's my thinking. Yeah.
You just don't identify.
Yep.
Yeah, now the numbers on the contract are just going to be, you know, the sale and the down payment on the sale. The borrower's numbers with us are going to be a little bit different because it's going to include that reno. So when you go to do that purchase contract, if they're buying the house at $100,000 with 3% down, it's $100,000, 3% down. The seller's not concerned with what they're putting into it and what their true down payment's going to be with us.
True.
So don't let the seller get confused about their numbers, because their numbers with you on the contract are going to be different from their numbers with us. You know, so have them consult with us about their cash to close, the actual down payment, and all that.
Now, their mortgage contingency amount will be correct on the purchase contract. So, for example, that one I showed where the purchase was $290 and the mortgage was $291, you know, how does that work? Well, the $291 is on that mortgage contingency. Our most important reason, we're protecting our buyer, right? Think about it. Like, that's not the greatest example, but let's say they're buying a house and it's $400 and they're anticipating $50K in reno-ish, right? And that's the deal they made. And that's what they went under contract. And they have an inspection contingency, don't they? And they have a mortgage contingency period, right? Now, during inspection, we get all the numbers we need and we find out it's not a $50,000 renovation, it's a $150,000 renovation. Whether they can afford it or not, the purchase contract says they can't. So if they're not looking to spend $150,000 renovations, they're not going to lose their deposit, right? Contract is the contract. Purchase price is the purchase price. But the mortgage contingency is the mortgage amount. So they'll be different. They'll be weird.
And to that point, when you're going under contract, really all we need from you is, hey, Mike, I think this needs like 30 grand, or I think it needs 50 grand. I can put that number in there, get them pre-approved. You can get them under contract with that number in mind. And if that number changes when the bid comes in from the contractor, now we adjust our numbers. And now if they don't qualify anymore because it went up drastically more than you thought it was going to, you've got a way out. You've got a way to back out.
We can say to them, hey, look, you know, you saw the bid. It's 50 more than you thought, but yeah, but we love the house. Mike, do we still qualify? And Mike's like, yeah, you still qualify. The payment goes to this, payment goes to that. We make our changes and we go forward. But if they're like, oh, geez, we told you we didn't want to go for a $100,000 redo, you know, he's got them pre-approved for what they're pre-approved for, you know, and the mortgage contingency for what they're pre-approved for. And I don't get into a lot of this in these shorter things, but I'll just mention, you know, you hit the nail on the head. Timing, you know, it's always kind of the big question. There's no right or wrong way. The bigger jobs, the non-limited, do you guys ever hear the difference? You hear limited 203K versus a standard? You ever hear about that? It's simple. If it's over 30,000 worth of work and or structural in nature, then it's not a limited anymore, it's a standard. And all that means is we have to involve this third-party inspector, this HUD consultant. They're home inspectors. You guys know them. You know them. They're just home inspectors, most of them. But they're HUD consultants, right? They're the third-party liaison. They work with us. They work with the contractor. They get the numbers all aligned and all. But the limited jobs, they don't even use that guy. It's just the contractor, the buyer and the contractor, right? So it's not always the same timing and stuff. Sometimes their offer's getting accepted. They haven't had a contractor in the house. They're basing it on what they think. They've been in the house a couple times. They think they know what it needs. Sometimes there is a contractor there and we have a real number right away. Sometimes house goes under contract. We send the home inspector and guys like us say, send one of the HUD consultant home inspectors. This is perfect. You get him in there early as a home inspector. He's just doing a home inspection. Even if we don't need him as a consultant, he's still looking at it like FHA. He's still looking at it with FHA's requirements. So now we can know way before the appraiser what the house is going to require and what it's not. It's still the appraiser's words, you know what I mean? But the consultant inspector is trained to recognize FHA required items, things like that. So sometimes we send a consultant in early and let him work up numbers. Sometimes we send a consultant and a contractor in together. So it's different ways, yes.
The one that's under like the standard, I think you said, right? So that, what is that, just under 30 grand?
That's the limited.
The limited.
Yeah.
And my second part of my question is just the one that is over that you have to have the HUD, there is extra cost to the buyer with the inspections
There is.
back and forth.
That's a great question. So if it's over 30 and it's structural or both or whatever, now it's a standard. You have to have this consultant. His fee is based on the amount of work. Okay. So his fee ranges from $600 to $1,000, depending on how much the renovation is. So if it's $35,001, it's $600, and then it scales all the way up. If it's over $100,000 renovation, he charges $1,000.
And is that out of pocket?
That's usually out of pocket, and it's the only other out of pocket than the appraisal. It's like the appraisal. A lot of them will collect half up front and then let us finance the other half. Now the rest of the cost, like you said, on the bigger jobs, would only be like the inspections post-closing, because that guy goes out there and as the work gets completed, he tells us, okay, they framed, and then we release that chunk of money, right? So those inspections though, right, all that stuff is built into the renovation. So those costs, those post-closing costs, are all already paid for in finance, so the buyer never sees them. They never have to pay them. On limited transactions, I used to say we do equal amounts. We probably do more of the big ones even nowadays than even the limiteds. But the limiteds, so you guys know, it's just the buyer, the lender, and the contractor, right? It's easy. It's we give the guy half of his bid at the table, at the closing table. Right. He's got a $28,000 job. He gets 14 grand. This roofer that I found this morning, he's like, I like those jobs. I said, I bet you do. You know, gets half his money. When he's finished, he shows us he's finished. He proves it. There's no liens or anything, and he gets the other half of his money. It's really.
Why did I think it had to be under 5,000? What's that?
5,000 is.
That's probably an escrow holdback you're thinking of.
Escrow holdback.
Yeah.
Oh, maybe you're thinking of that.
Okay,
I thought you were talking about like limit minimums.
That's what I was just getting
on
confused,
rentals.
like the limited versus what the escrow holdback.
Yeah, escrow holdback usually is limited to around 5 grand. Depends on the company, the lending company.
Got it.
Yeah.
Yeah.
And
I was
depending on
getting
the
those
work.
confused.
And depending on what kind
Yeah.
of work it is.
Yeah.
Okay, cool. Thank you.
Yep.
Now there is I'm sorry, go ahead.
Is there a timeline limit in order for the inspections, or sorry, the renovations
Yeah.
to be completed?
The guidelines, the limiteds have a 4-month timeline and the standards have a 6-month timeline. As a direct lender, I can tell you, we have the ability to extend at any time on any of them. Fannie Mae allows up to 18 months for them to be final. But the contracts all say 6. We have these big jobs, like we have a $270,000 rental starting in 2 weeks. They just closed. That'll take them all of 6 to 9 months. Hell yeah, you know. But if it takes them longer, we'll just push it out. We'll have them push it out. It's a matter of we keep in touch and communication, you know.
Can the homeowner live in the house the entire time?
It depends on those limiteds. So, right, under 30 grand, no consultant, all that stuff, it's a no-brainer. They close on Friday, they move in on Saturday. The contractor starts his work on Monday. Great. Even if they're ripping the kitchen apart, they want to eat pizza for 2 weeks and live at home, they can. There's nothing to stop them from moving in. On the big jobs, hey, we're tearing the roof off, you know, the consultant, the inspection consultant is going to actually, in his report, state how long the house is inhabitable. He'll say 60 days, uninhabitable. Now they could take those first 2 mortgage payments and roll them into the renovation.
But the good news is we can roll in
Up to 6 months.
So if they're living in a hotel or a rental situation.
Yeah. And by the way, if they are living in a rental or something while this is getting done, that rental payment does not factor into their qualifying, just so you know. Because they're closed, they have a house. It sounds kind of silly that like they still have to pay that rent. Yeah, but it's not factored in. So
So they have to pay the rent and the mortgage in that time frame?
No.
Mortgage payment. So the first three mortgage payments, if the house is uninhabitable and they can't move in yet, and they say, well, it's going to be 3 months, it's going to be 3 payments deep by then, we can wrap in 3 mortgage payments into that rental cost.
But then after 3 months, though, they would have to be responsible for 2 payments.
Correct. Yeah. Right.
So that has to be managed.
Well, no.
Meaning if it goes
After 3 months, they're moving in.
hopefully.
Well, if they're not, then we can add the extra 2 payments. They can go up to 6 payments.
Oh, to 6. Okay.
Yeah, we'll take it out of the contingency reserve. Yeah.
Okay.
Yeah.
Are you guys aware of the contingency reserve? Not to get too into the nuts and bolts, but
It's not stuff I get into too much in terms of, because it starts to confuse
we do.
everybody with stuff.
Well, we do have to qualify people for an extra 10%. If the utilities are off, an extra 15%. If the structural work, 15%. Right?
No. If the utilities are not turned on, it's 15%.
Like a like a foreclosure.
Right. So in other words, if it's 30 grand in reno, we have to qualify them for 33. Right. So that rental cost, the people are going to see that number and it's going to look all jacked up. And chances are they're going to come running to you first and say, these numbers are not what we talked about, right? So that extra 3,000 is sitting on the sidelines in case contractor comes in, opens up the wall and says, oh, this pipe is wrapped with asbestos and I need to get a crew in here to clean this out. We've got contingency reserve for those types of changes. And that money will come out of it.
But they never see different numbers. Their renovation cost is always including the contingency, always including the inspections. So if I get a bid for 30,000, it's $34,209. You know, because you can't go over 35. The real guideline is 35,000, but that includes the contingency reserve, includes those things.
But the customer might know that it's a $30,000 bid from the contractor, and now they see their total rental cost is quite a bit higher. That's the explanation, is we have to add in that extra contingency, you know, just in case.
And what we should be saying if we want to be limited to the contractor to keep it under 30.
Right.
Sorry.
Correct.
To keep it under 30.
Correct. Exactly.
And that money at the end, if not spent, will go towards paying down the balance on the mortgage. So it basically just turns into equity.
Or they can use it to do another, they could buy a refrigerator with it. Yeah, right. They could use it for more work. They could use it to buy nicer.
If there's leftover?
That contingency reserve. Many times, it gets used many times. So if the job is, 53 grand, they've got 5,300 left over. They shouldn't overrun, but between the borrower and the contractor, they always use it. They always use it. But if they don't, we'll put it in the principal, or they can use it for something else.
But they have hardcore bids before the work even starts.
Yep.
So what happens, like, are they under contract with the contractor?
Well, they sign an estimate, they sign an agreed.
So what happens if the cost of materials goes up, and does the builder try to pass that, or the contractor try to pass that?
I don't get in between deals between customers and their contractor. You know what I mean? Like if his price goes up, he's got to if he wants to raise his price to somebody that he made a deal with, that's between him and them.
Right, but if he has a contract with my client for $25,000 for the kitchen, or maybe not the kitchen, something like the roof.
Yeah.
He can't go to them after they've signed the contract and say, well, now it's going to be 30.
He might be, after they're closed and funded, he might remove the roof and find out that there's, a family of raccoons that ate through all the plywood and no one knew about it. That contingency reserve is there to help if something weird happens. They go through a wall and he finds something he wasn't expecting, kind of thing. But as far as him changing his bid, changing the numbers on it, he can't do that. I mean, that would be grounds for lawsuit, I would think. Okay. No, yeah. No, but to answer your question, no, we don't get them coming back to us and going, hey, you know what, our costs went up, sorry.
No, I think the contractors put this quote is good for a certain time because they know the cost of stuff. Yeah. Like I had a roof done. Some of them do. Yeah, and he said by the end of March, I can't honor this price because prices are going up. They know what their prices are.
That's a good point. But you make a very good point though, because like during the pandemic with the supply chain nonsense, guys couldn't get things and then the prices were going up at the same time and they were like, man, by the time I start this job, the lumber's might be 50% higher. And that was happening. But it was a crazy, unpredictable time. So it hasn't been like that of recent, thank God. Yeah. Well,
thank you guys so much for doing that. It was Excellent, great information. And